Hello friends. Thank you for all your wishes and your concern for my health. I'm recovering well and I continue in this voiceover method for another weekly market outlook video. Hopefully, I'll be back in the usual video format extremely fast. Well, last week I told you that the market was good for scalpers rather than traders who would roll over their position to the next trading session. And that viewpoint was validated by the market by the extreme movements intraday basis, especially on Tuesday and Wednesday. And if you were to roll over your position from one day to next, you would have to be extremely careful and not get taken caught on the wrong foot. What lies in the week ahead? Let's dive right in. On your screen right now is the market roundup window, which tells me that it was a banking space which continued to steal the thunder from the broader markets. And the US dollar index actually eased back below the 109 levels, which imbibed a sense of optimism in emerging markets, including India. 10-year benchmark bond yields eased off by 8 basis points, which is again another bullish indicator for the Bank Nifty, which is why you're seeing the Bank Nifty outperform the Nifty 50. Now, since the US dollar index eased and commodity markets therefore saw gold and silver see buying emerge back again, because the dollar is the invoicing currency in commodity markets, and a weak dollar becomes automatically a boosting point for hard assets. Crude oil fell a little under 0.5%, which was another feel-good factor, but it was clearly natural gas which boosted sentiment significantly because it fell a little under 10%, which is extremely bullish for emerging markets. The USD INR fell below the 80 mark, which means the Indian rupee gained 36 basis points versus the US dollar, which is again another sign of optimism, which reflected in the NSE market capitalization, which rose 1.65% on a week-on-week basis. MWPL continued to rise, and the US markets also saw the headline indices rise handsomely. Coming on your screen right now is the daily chart of the Dow Jones Industrial Average, which rose on 3 out of 4 trading sessions, Monday being a holiday due to Labor Day. Now, what we are seeing is that the death cross remains in place. The 50-day moving average remains below the 200-day average, but the price is now headed towards the 50-day average. The 31,886 support level, which had become a resistance after being violated, has been overcome again. For the bulls to really return back in force, we need the 33,272 level to be overcome. Will it do so? The coming few trading sessions will let us know. The Nasdaq 100, remember, this is the index that determines the shape of our information technology software company stocks, also saw a rally on 3 out of 4 trading sessions last week. Here again, the death cross remains in place. The price is back above the upward sloping trend line, which it had violated briefly. But what we need to watch out for is whether the 12,898 level is overcome or not on a sustained closing basis. Do remember how in the last 3 trading sessions, exactly like the Nasdaq, our tech stocks have also bounced. The S&P 500, the broadest index of the 3 that we discuss here, has not yet violated the bullish trend line, and the death cross here remains in place. What we do need to see is whether the 4,178 level is overcome on a sustained closing basis. If it does, you can see the cheer returning, at least in the near term, in the US markets. Coming back to our domestic markets, on your screen right now is a weekly chart of MWPL. What we are seeing is a humongous 4% plus rise on a week-on-week basis in MWPL. MWPL is nothing but the percentage exposure that traders have utilized as a component of the total percentage exposure allowed by SEBI, the Indian regulator. Will it cross the 31.13 level, which is the highest in 5 months? I'm betting in the coming week it will. So what you are seeing is that the MWPL bottomed out at 2209 in August expiry, 21.48 in July expiry, and 19.75 in the June expiry. So for 3 consecutive expiries, the bottom has been higher. That logically means that the top should also breach and overcome the 31.13 level. Risk expansion is clearly back. So that's another sign of optimism for the bulls. Now we come to the turnover of the individual stock futures versus the index futures. Index futures turnover fell on a week-on-week basis, whereas the individual stock futures turnover is the highest in 3 weeks. That is a sign of risk appetite returning back, because stock futures tend to be more volatile than indices, and traders are open to the idea of taking higher risk. Now for the basis chart on your screen. The basis is nothing but the discount or premium enjoyed by the future over cash. And what we are seeing is the bank Nifty premium, the basis, has eased a little bit from 121.25% in the week before last to 88.18 last week. That tells me that there's been a little bit of hedging and even profit taking on long positions at higher levels. The Nifty, on the other hand, has seen basis expansion from 23.30 in the week before last to 33.10 last week. That tells me risk appetite actually went up because the bears were forced to cover their shorts, which is what resulted in basis expansion. So as I wrote to you on my Telegram channel, short covering will cushion declines, and that's precisely what we are seeing. On your screen right now is the NSE Advanced Decline Ratio, a very simple metric but extremely effective. For the second week in a row, we are seeing Advanced Decline Ratio staying below 1. It's a simple tool that measures the number of shares rising versus the number of shares falling, and last week we saw for every 100 shares falling, only 81 shares were rising. This needs to improve a whole lot more if the upthrust is to sustain. This is the only metric which has given me some sign of mild caution, although things can improve substantially overnight as well. We need to wait and watch. We need to let the market tell us where it's going. Now for the impetus chart, something that you've learned to rely on for almost a year and a half. Both the indices, Nifty and the Bank Nifty, saw their impetus reading go up. That means the upthrust was on higher buying momentum last week, which is a good sign. We want prices and the impetus to rise together if the upthrust is to be sustainable. Let's watch this metric very keenly. Now for the LWTD, the Nifty percentage gain loss line went above 0 at 0.19, but the LWTD remained marginally below 0 at minus 0.06. That tells me that at higher levels, buying support is a little limited. And do remember what I told you, it's the short covering rather than fresh buying which is propelling the basis higher. We need the LWTD, which is a red line, to go above 0 along with the Nifty percentage gain loss line to rise persistently. That would be my precondition for going out and buying aggressively. I update these charts on my social media accounts late night every day. Do connect with me. My contact coordinates come at the fag end of this video, and you can update yourself every day. Now for the footprints of the 4 market participants, starting with the FIIs who've reduced their individual stock futures long positions, and they've also cut down their index short positions mildly. So they remain defensive net. Where DIIs are concerned, they've cut their individual stock future short positions mildly, but they've stepped up their index shorts significantly. So they're playing a hedged game. Where prop traders are concerned, they've increased their futures in net long positions in individual stock futures mildly, and they've cut all their index shorts and gone net positive to the extent of 892 lots. So the prop traders who are brokers own proprietary trades. These guys are super sharp traders. They know who's buying, who's selling, what price and how much. So they're second best to insiders. They seem to be a little more optimistic on a week-on-week basis. Back to the retail guys who've done all the heavy lifting after the COVID-based lockdowns were imposed. Their individual stock futures net long positions are back above 1 million, which is 10 lakh units, 10 lakh lots. And where their index net longs are concerned, they've come down marginally to 1,02,214 lots. Very marginally, but risk appetite has definitely grown because of the individual stock futures positions. Friends, I now come to the four index heavyweight stocks which swing the markets with their own price. Starting with Reliance Industries, heaviest weighted stock in the Nifty with a weightage of 11.51, high beta at 1.11, which means if the Nifty moves 1%, this stock moves 1.11%. The fall on Friday is noticeable. Like I mentioned last week, I would want this stock to go above the 2,618, I beg your pardon, and stay above this. With the sheer weight that it has in the Nifty, that would boost the market significantly. We need to watch that threshold keenly. HDFC Bank now, the second heaviest weighted stock in the Nifty at 8.36%, and the heaviest weighted bank Nifty stock with a weightage of 26.21%. So it impacts not just the Nifty, but the bank Nifty as well. This stock seems to have edged higher. It's staying above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of the bulls. And should it cross the 1525 level and stay above it, I think it can actually add a little bit of a muscle to the bulls, both in the Nifty and in the bank Nifty. Third heavy-weighted stock in the index, Infosys with a weightage of 7.54%. Remember the NASDAQ 100 chart we saw in the US section. The last three trading sessions of the week saw the NASDAQ rise. Exact same situation in the technology space here in the Infi stock. And what we need to do is see whether the primary hurdle of 1,555 is overcome or not. Once the gaps which it has left on the way down are filled, and the price swings higher to close the gap at 1,728. Now that's a long shot from here. I think technology will start adding muscle to the markets if and when it happens. So let's wait and watch. Finally, the strongest chart of all four charts that we've discussed, ICICI Bank continues to surge higher into blue sky territory and remain above its 867 level, which is almost a 10-month high hurdle that it was facing. The price is comfortably above its 25-day exponential moving average, which is a month-long holding on cost of the bull, and the outlook remains positive. So net, I would continue to watch HDFC Bank and ICICI Bank, and I would put Infosys and Reliance on watch. Friends, I now come to the weekly chart of the 10-year benchmark bond yields, and yields, remember, have continued to ease, which is why I constantly reminded all my friends on social media to continue to ladder your fixed income investments, especially in the sovereign space, on the RBI Retail Direct platform. Would I allocate further funds to benchmark bond yields. I think I would, if at all, was resorting to SIPs or systematic investment plan, which is a very good idea and I support it completely. I would continue to ladder even at 7.15% yield. I don't think we are breaching the 7 round figure very soon, and if at all we go past the 7.27 odd levels, I think yields might just start rising again. So don't bother about the innuendos. If you're doing your SIPs and bonds, continue to do so. Friends, I now come to the US dollar index, which actually lost 64 basis points because it fell on 4 out of 5 trading sessions. What you are seeing on the daily chart on your screen is that the price has now tested the 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. Now that that support has been tested, what we do need to watch out for is whether the price falls below the 108.50 level in the coming week. If it does, good news for emerging markets, including India, and our landed cost of imported products, especially fuels, will ease. Therefore, imported inflation will ease a little bit. Look at the weekly chart on your screen. What you are seeing is a big bearish red candle piercing into the body of the previous bullish one. That's a bearish piercing pattern on the weekly chart. And the price is far away from its 25-week exponential moving average, which is a proxy for a 6-month holding on cost of a bull. The medium-term outlook remains positive, but mean reversion, which means the price getting closer to the moving average, is a possibility that you need to keep an eye on, which means that there could be consolidation in the Dixie's price movement in the coming days. Good news for emerging markets. Last week, I advocated a range between 111.50 on the upside and 107.75 on the downside, which held perfectly well. In the coming week, I expect a range between 110.90 on the upside and 107.05 on the downside. Friends, I now come to the Bank Nifty, which stole the limelight from the Nifty by gaining 2.52% on a week-on-week basis. And as the daily chart on your screen tells us, it rose on 3 out of 5 trading sessions. Now the price remains above its 25-day exponential moving average, which itself is going higher, which tells me that the outlook remains positive for now in the absolute near term, with the 38,750 odd levels being a fairly good support base to watch out for. As long as the price remains above this level, the bulls are still in the driver's seat, some short-term corrections notwithstanding. Coming to the weekly chart, what we are seeing is a second week of significantly strong bullish candles. The price is comfortably above its 38,759 swing high of April 2022. As long as the price keeps surging above this level, the bulls are still in control. The price is above its 25-week exponential moving average. That's a proxy for 6-month-long holding on cost of a bull, which means the medium-term outlook is also bullish. But the big gap between the price and the moving average tells me that some consolidation or even a corrective decline, I'm using the word correction, not reversal, a corrective decline might just be in the offing, which should not surprise us at all. Now, in the week before last, this index was number 5 on our in-house highest volatility counters list. It rose 1 notch last week to go to number 4 on the highest volatile stocks list. That's a little bit of a challenge for retail traders because high volatility can cut you both ways. Last week, I advocated a range between 40,950 on the upside and 37,900 on the downside, which held beautifully well. In the coming week, I expect a range between 41,950 on the upside and 38,875 on the downside. I continue my advice that you should trade light, maintain stop losses, and wherever possible, square up your trade on the same day rather than rolling it over to the next trading session. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.68% on a week-on-week basis, rallied on 3 out of 5 trading sessions, and as you can see on the daily chart on your screen, has broken out above the downward sloping trend line, which connects all the tops made after October 2021. The price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull, so the short-term outlook remains positive for now. And the 18,000 round figure is just a psychological hurdle that we need to watch out for. I think the Indian market's outperformance of its global peers is likely to continue, which does not mean that the Indian markets will continue to rise when the global markets are falling. It's just that we might fall less, and when every market is rising, we will rise more than the others. That's the concept of outperformance. Now take a look at the weekly chart on your screen. The weekly candle has closed above that trend line for the first time after this trend line has been drawn. I would draw comfort from the fact that the closing has been above the trend line itself. What I would want is the 18,115 previous swing high of April 2021 to be overcome forcefully, so that it indicates the bulls are coming back in the driver's seat. Here again, the price remains above its 25-week exponential moving average, which is a proxy for a 6-month-long holding on cost. So the difference between the price and the moving average tells me that there is some possibility of a corrective decline. That should not really surprise us. In the week before last, this index was number 16 on the most volatile counters list in-house. It rose 2 notches to number 14, which means a little bit of increased challenge for traders, which is why I told you that you should square up your positions wherever possible profitably intraday itself rather than rolling over your positions to the next day. Last week, I advocated a range between 18,100 on the upside and 17,000 on the downside, which held in spite of all the volatility. In the coming week, I expect a range between 18,375 on the upside and 17,275 on the downside. I maintain my view that you should continue to trade light and maintain your stop losses extremely diligently. Friends, the final bit of charting and statistical evidence on your screen right now is the proxy for retail risk appetite, which is denoted by the percentage turnover in options and futures. So higher exposure to option means that traders are a little cautious, and higher exposure to futures would mean that their risk appetite is growing. The olive green line, which tells you that the turnover has hit a fortnight high in individual stock futures, is an extremely comfortable point for me, because last week's rally in the markets has been with higher risk appetite. Traders are actually taking bigger bites out of the market, which tells me that support will possibly come at lower levels as well. I now come to the most popular segment for statistical model traders or mathematical model traders. I give you 5 stocks with the highest impetus gainers on Friday, which you will trade on Monday in small lots waiting for large price moves, and 5 stocks which lost the most amount of impetus on Friday, wherein you will trade in big chunks on Monday waiting for smaller price moves, and this is for scalpers. This list and hierarchy changes every day. Should you wish to be updated Tuesday through Friday, please connect with me on our Telegram channel, wherein this list and a whole lot of other cool stuff is updated every single day. So the impetus gainers list is led by Gale at number 1, number 2 ACC, number 3 Dalmia Bharat, number 4 Shree Cement, and number 5 Apollo Tires. The impetus losers list is led by RBL Bank and number 2 NMDC, number 3 Chambal Fertilizer, number 4 IDFC, and number 5 Can Fin Homes. Friends, before I bid goodbye to you, a humble reminder to subscribe to my YouTube channel if you liked what you saw. And in the comment section, please do let me know what you think of our work and what we can do to get better. I would also request you to share my videos with your social media friends to help me reach out to fellow like-minded smart investors and traders like yourself. And thank you for your patience in being with me in my video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.